While record high prices haunt most of us and the affordability crisis is becoming more of a concern with every day that passes, bidding wars have still not cooled down. Last year, when housing prices started to decline after an absurd appreciation over 2 years, the market analysts shared their predictions about the next year. The Case-Shiller Indicator marked a decline for 7 months straight, and the analysts hoped this was where the long-awaited real estate relief would start. The assumption was reasonable because prices had not receded to such levels since 2008. Indeed, when you make a comparison, you'll find that the market fell even faster than during that crash. However, the fleeting sense of relief didn't last long. The tides began to turn as we entered 2023, and the market regained its momentum. As we progressed toward summer, the housing bubble started anew. In many cities, the prices have not seen a drop worth mentioning since then. The buyers are once again battling with elevated prices and mortgage interest rates touching 7%. Affordability largely depends on housing prices combined with mortgage interest rates. So comparing real estate trends based on these factors combined is better than viewing them independently. Let us put it into perspective for you. You see, a house that sold for $171,400 in Ohio in March 2020 reached a median sale price of $240,700 in March 2023. It is about a 40% appreciation in almost 3 years. Including the mortgage interest rates in the equation provides a better indication of affordability than focusing solely on home prices. An average payment has gone from $1,100 to more than $2,000, rounding up to more than a 90% increase. Therefore, affordability is worse than it ever has been. So what about the much talked about crash? Why are we not seeing it already? Before we get to that, please support our channel with a thumbs up and don't forget to subscribe to our channel. Now, if you look at the trends from last year, you will notice that the real estate prices hiked exactly around this time before going down in the winter. An average house in Ohio that sold for $240,100 in June 2022 was on the market for $209,800 around Christmas. In 2022, that was the significant decline that many of us hoped would result in a long-term bear market. One of the factors contributing to the decline was seasonality. It is typical for the market prices to peak around spring and summer before declining as the winters arrive. But the downturn that we witnessed last year was bizarre as the prices in some states fell more than 20%. It left many of us wondering whether the trend would repeat itself in 2023 as well. And if it happens again, how far are we going to dip this time around? And what factors will contribute to this year's housing market trends? Considering the speculations about a potential recession hitting us in the fourth quarter, what factors or catalysts could aid the market's revival in the spring? There is no consistent pattern in the market activity observed in different cities and states. A series of various occurrences have begun to change how we view real estate. The epicenter of the imbalance is a city that seems to be in a crash already, and market experts are wondering whether other cities will follow similar trends. Austin has everyone confused in the real estate industry. The town managed to survive the 2008 crash unharmed, while other markets experienced turmoil. The Austin market, which remained flat from 2007 to 2011, is poised for correction in 2023. The city is crashing faster than ever. In the 2000s, it took Austin more than 3 years to fall 8.5%. However, this time the prices have declined nearly 10% in only 9 months. You might be wondering why it matters when the market is still well above the normal levels of the pre-pandemic era. Moreover, a 10% decline may not appear significant when compared to historical data, which shows a 28% decrease in prices. However, the crucial aspect to consider is the speed of the current crash. In the previous instance, it took 4 to 5 years to reach a 28% dip, but if the current pace continues, the losses will surpass those of the previous crash. Furthermore, when you compare the circumstances, the situation in 2023 differs from that of 2008, as there are no widespread bankruptcies or high levels of unemployment. On top of that, the supply is pretty tight. It is a well-known rule that tight inventory is inversely proportional to housing prices. Still, experts are not sure why a market like Austin continues to decelerate. There are several other markets that defied this supply pricing rule. Another similar example is San Francisco, which has seen a more than 13% decline. The impact might not be quite widespread across the nation, but it is evident enough to mean something. We have seen over and over again that the prices declined despite the low housing supply. They not only experienced a decline, but also decreased by an unprecedented margin never witnessed in history. Consequently, one thing is evident: the supply pricing dynamics have been severely misunderstood until now. The market activity is not solely driven by this rule. In the current scenario, factors like interest rate hikes and affordability concerns have changed the norms of consumer behavior. Typically speaking, real estate is an illiquid marketplace because its investments take time to repay. So prices in the past were also not determined entirely by market activity, even though the inventory was not as tight as today. Now, when we only see a couple of houses for sale in an entire subdivision, real estate transactions only have a little to do with pricing. Investors have a significant role in framing the equation. According to the data by Redfin, every 1 out of 10 houses are purchased by investors. The number can be higher if you consider mom and pop investors too. An investor operates by different code of conduct than an average buyer. These individuals are highly sensitive to price fluctuations because most of them are leveraged. By this, we mean that their purchases are based on loans. As the Federal Reserve Bank raises interest rates, obtaining loans is becoming increasingly challenging, which means you cannot expect investors to quit anytime soon. They're likely to dump the inventory only when the situation worsens. Unlike typical home buyers, investors cut prices quickly and start panic selling when the market undergoes extreme turbulence. They lose sight of their long-term plans as soon as the media gets noisy about the downfall of the market. Refusing to be the last ones to hold on to the inventory, they will sell their properties even if it incurs heavy losses. It is a peak buying season, so we see them calm in controlling the markets in entire neighborhoods. The real test lies ahead of them. Everyone is glued to the market news and making their own predictions. If the seasonality kicks in and we witness a decrease in median prices like the previous year, then we will see the real panic. The real point to ponder is what will happen to the housing market if the recession actually hits us in Q4 of 2023, while a seasonal decline is also in play. Also, what happens when the spring buying season once again picks up at the beginning of 2024? We have not seen a downturn in the economy since 2009, but if the speculations come true and a recession hits the economy, we will witness massive changes in the market. Unemployment will jump up, constricting the demand for houses even further. Builders will pull back, and the odds of a spring price hike like 2023 will be weaker than ever. On top of that, the fleeing investors will kickstart a downward spiral like the one we witnessed in Austin, but in other cities as well. You can expect the onset of a prolonged bear market in 2024. Another factor that will essentially shape the future of the market will be the Federal Reserve Bank. If it continues to increase the federal funds rate, it will indirectly affect housing prices. The impact of government borrowing trickles down to the economy and impacts the markets by determining interest rates. In addition, student debt payments are resuming in the fall, and that will also leave ugly effects on the market for sure. It's evident that if a majority of working-class Americans are having trouble paying their loans, they cannot realistically contemplate leveraging another loan to purchase a house in the near future. As a result, the real estate crash will become more and more inevitable. So what is advised for you as a buyer? Despite all the insights, the ultimate trajectory of real estate is highly unpredictable. One moment, everything looks stable, and then everything goes downhill the next. A wise person will go with the market's flow. If you buy a house and the market crashes, your property will lose value. This fact does not seem encouraging, considering that we might face unforeseen economic challenges in the coming months. Try not to get yourself stuck in deals that will cause you more harm than good in the long run. Thanks for watching. Please like, subscribe, and comment below, and watch this one as well.